Yeah, chapter 2.1, an overview of charting. And we'll try and complete this and the next chapter, which is on x-axis, in today's class. If not, we'll cover that in the class later in the evening. So really, if you look at the history of charting, it came down to the fact that there were commodity traders who wanted to figure out what was the price at which somebody was selling a particular commodity. And if you look at the history, it was typically something that was attributed to Japanese rice traders who would just plot the prices at uh, on a chart, and then just draw a line along those to be able to create the chart of how the prices have moved over a period of time. Okay, and it's pretty straightforward, where you looked at hand drawn charts and really just kept what was the close price on a particular day, and that kind of led to the line charts being formed. So there was a particular price at which uh, rice was sold at on a particular day. That was the price that was taken, and if you plot that over a certain number of days, you would get typically what is a line chart, which is similar to what we see in a lot of uh, the charting platforms even today. So if we go back, so in most of the line charts, what you see is that it provides a history of how the prices have moved, but typically it only takes the close price of a particular day. If you're looking at the hourly chart, it will show you how the prices have closed for that particular hour, and you'd be able to see whether the prices are moving up, whether it's moving up with some movement both up and down, or it's moving down. All those things can be gathered, but what it does not give you is that what is the range of price. Okay, so did the price on a particular day open over here, go up till here, went down over here, and then close somewhere over here? Okay, so it does not give you the entire range of the prices, because of which there were many other ways of charting that came up over a period of time. But if you actually look at it, line chart is one of the easiest ones that is there in the market, and it does reflect market behavior, and it does tell you a lot of repetitive patterns that happen in the market. Okay, so it's important for us to be able to understand what the line chart tells us. It basically tells us what is the closing price of that particular security on a particular day, and then it shows all the things that you typically look at for trends, whether it is a pattern. You can see those in line charts also. So what we have over here is a line chart for Home Depot, okay, from January to August 2020. Now, some of you who remember the 2020 timeframe, you'll see that the February March time period over here was where the prices kept falling because of COVID, and not only Home Depot, all the assets actually went down during that time. Now, while it does not tell you a complete picture of what happened to Home Depot, you know, within the day, but it gives you a very good idea of the fact that, okay, this was a time that the prices were falling, and then after that the prices started rising, and the prices have kept moving up with some small time period where it was within a range. And again, going back to what we studied in the previous session, that the prices stay in a range for very little time compared to the times that it moves. So there was a little bit of a range over here, a little bit of a range over here, then moved up, small range over here, moved up again. So if you actually see prices on a chart, you would actually see the fact that most of the price times prices move whether up or down. There's very little time where the price just stays within a range. So if you look at this particular area, there was a little bit of a range, and then price broke out from that particular area. Again over here, a small range, and then price broke out. So if when you're looking at actual charts, you can relate to the previous chapter where we were saying that as per the arcsine law, the prices stay within a range for a very low period of time. Most of the times it is either moving up or moving down. But line charts are very easy to look at, very easy to interpret. It just shows you a sequence of prices, uh, and mostly closing prices for a particular day. To construct a line chart, it's quite easy. You just need one data point, which is typically the last price where the stock traded. Okay, so if you look at the prices that are even published in most of the newspapers for a particular stock, or you see something scrolling up on your screen on CNBC or whatever platform that you use, the prices that are there at the bottom is the last traded price. So if you see it at the end of the day, it's the last traded price for that particular day. Now, obviously, it has some benefits. One, there's convenience, okay, because you're only looking at the close price. You're not looking at how much prices moved during the day. There's consistency because of the fact that it is collected at the close of the market every day. So you know that this is the price at which the market closed on a daily basis, and that uh, uh, Jataneshwar, I didn't get your question on Fibonacci sequence and golden ratio. If that question is regarding how you build strategies, yes, you can use anything. You can use just price patterns. You can use Fib sequences. You can also use uh, indicators to do that. It really depends on your comfort. I don't use both Fib as well as golden ratios because of just the complexity in terms of coding it. But yes, people do use that. So feel free to build a methodology that you can use based on what your comfort zone is. So if Fib is something that works for you, great. Coming back over here, convenience, consistency, and capital requirement. Okay, now what happens is that typically a lot of the capital requirement, even NAVs for particular mutual funds, is based on what is the last traded price for that particular security. And based on that, if you look at, there's something called MTM, mark to market. So if you're doing a futures transaction, what will happen is that every day there will be a mark to market. If you're in profit, the broker will add that money to your account. If you're in losses, they'll take that money from your account. And that is based on uh, what the closing price of that day is. Okay. They'll do it within the day also, but typically at the end of the day, if you do not have enough capital in your account, that is where the broker will ask you for additional capital, especially if you've suffered losses without the right amount of capital in your account, and that is called a margin call. And then the sentiment. So typically, the last price of the day is what you carry over to the next day, and especially people who are carrying over position, it is something that is important for them because that is something that they cannot modify. The other thing is also closing price is important because most of the big players, they typically bring in most of the orders during the last few hours of trading. Okay, it's said that the markets are opened by amateurs and closed by professionals, and that is why, again, it is important to understand what is the closing price, because closing price incorporates a lot of those things. So a mutual fund that wants a particular NAV would want those prices to close at a particular place. Okay, if there is a large futures trader who wants to manage his mark to market, they'd want the closing price to be at a particular place, and they are the ones who can actually move the prices. Okay, so you and I, as retail traders, would find it very difficult to actually move the prices, while some of the institutional players would be actually able to move the prices to a level that they want it to close at. The next type is something called a bar chart. So till now, what we've seen is you have a single point each day. This is where the price is closed. This is where the price is closed. This is where the price is closed. But you don't know how much the price is moved on a particular day. And that is something that the bar chart will tell you. So bar chart is nothing but on on a graph. This is where the price opened. So you'll have a tick on the left hand side. It went up and it closed over here. Okay, that is the tick on the right hand side. This can be one. This can be another one. Prices opened over here, which is the left tick always. It went down, it went up, and then came down again, and then closed over here. Okay, so this is how that particular bar will look. Suppose this is where the prices opened, went up, went down, went up, and then closed over here. This is how that particular bar will look like. So this will always be the open, the left side, the right side will always be the close. If the right side is lower than the left side, that means the prices have moved down. Here the prices have moved up. Here the prices have moved up. Okay. It can also be opened over here, it went down, and then it came up and closed over here. Okay. Even over here, the prices have moved down. Okay. But there was nothing that was above the opening price. So this is how the bar chart is formed. There are four pieces of information that is contained in the bar chart. Okay. One is the open, high, low, and close. So open is sorry, open is over here, this particular left side tick. Okay, close. This is the high, this is the low. Similarly over here, open is the left tick. Okay, OH high, which is this particular point. Then low, which is this point over here, and then close, which is this particular tick. That's how the bar chart is formed. Okay, on if you look at each one of those, so this over here is the opening price, the left tick, the right tick over here is the closing price. The price had a high over here and a low over here. Okay. Similarly, opening over here. Okay, this is the closing price. The price moved down a lot in this particular case, but closed at the high of the day. Okay. If you look at this particular bar over here, opening price, high, low, and close. Okay. So this is how a bar chart looks like. If you compare it with this, so the prices probably would be similar, where it went down, went up. Okay. And this is August 20 to August 31st. So if you look at over here, what did the prices do in August? Somewhere over here, the prices were actually going up. Okay, it does not have uh, data from March, but it does have August data where the prices are going up. If you look at it over here, also the prices were going up, went down a little bit, then went up again. So in terms of the number of data points that you can analyze on a bar chart is much more than what you can do on a line chart. Okay, here you have the open, high, low, close, which in a way tells you how much the prices have moved up or down. Okay, uh, each trading day is represented by one vertical line. The length indicates the trading range. So the trading range on this day was much larger than the trading range on this day. Why? Because over here the prices probably moved $2. Here the prices moved $8. Okay, and the length of that particular bar will tell you how much the prices moved, whether up or down. Okay, the bottom is the lowest price, and the top is the highest price. A longer bar represents a much larger trading range, and a shorter bar obviously means that the price did not move a lot. Okay, so over here, the price only moved within this range, which might be suppose $3, and here it might have moved $6 because from the top to the bottom, it's probably $5 or $6. But what you need to look at in the bar is that the longer the bar, the more the range, and even where those ticks are. Okay, over here the open and close were further apart from each other. Okay, the open was much higher, okay, and the close was much lower. Okay, even over here the open and close were at very different places. But over here, if you look at this one, the range was low, but the open and close was also very close to each other. Over here, the open and close are nearly at the same level. Okay, so if you look at it, the left tick and the right tick are exactly matching each other. Okay, similarly over here, the left and right tick are very close to each other, even though the prices moved, you know, much higher and went a little bit lower, but the open and close similarly over here is at the same place. So it does give you a lot more indication in terms of what the market is trying to do, and we'll talk about what is the indication if the open and close are very close to each other, and what happens when the range is much larger versus when the range is very small, like over here. Any questions on bar charts? Okay. Uh, so candlestick charts are very similar to bar charts in a lot of respects. The difference is that bar chart is really a very Western concept, and it was typically popularized, you know, in the Western countries till the time uh, Steve Nyson, published something called Japanese Candlestick Charting Techniques in 1991. And what happened was it was something that was used in Japan, and typically it is very similar to bar chart because it also contains OHLC prices. Okay, OHLC is nothing but open, high, low, and close. It has all those four data points, but the representation is a little different. Okay, so the typical candlestick, let's see, okay, has this kind of template where you have uh, a square box and then you have lines which go up and down. Okay, now depending on the color of the candlestick, okay, let's see, change color. Okay, now suppose this candlestick is red. Okay, the body of that candle is red. It basically means that the open was higher and the close was lower. Okay, so if you look at this as a bar chart, it would be something like this. Okay, or let's undo this a little bit. Let's try to do this. Okay, so the bar chart for this particular candlestick would look like this. Okay, so this was the open on the bar chart, this was the close on the candle. If it is a red candle, that means the close is lower than the open. Okay, so over here, because it is a red candle, you can understand that the open was the higher point, the close was at the low point of that particular body. The high is the top of that candle, or we call it the wick. This is the body of the candle. These two lines above and below are called wicks. The top is the high, this is the low, and the body of the candle basically represents the open and close. If you go ahead and look at a candle that opened over here and closed over here, then the body of the candle will be green. Okay, and this would be the low, this would be the high. So the wicks typically represent the low and the high, and the body represents the open and the close. The color of the body tells you whether the open was lower than the close or higher than the close. So this is the close. On a green candle, the close will always be above the open. On a red candle, the close will be below the open. Any questions on the representation in a candlestick? And most of you would have seen those even in normal charts, and we'll go to trading view right after this and see how that is represented on your actual charts. So typically if you look at the candlestick charts, you know horizontal marks are plotted at the opening and the close. Okay, now typically when you're looking at it in black and white, what will happen is that the white candles are the same as green candles. Okay, which means that the close is greater than the open. Okay, the black candles are similar to red candles where the close is less than the open, which means a black candle is a candle that is showing that the prices have fallen, and a white candle is the one that is showing that the prices are rising. So if you really look at it over here, what you can also see is that white or open candles are hollow or bullish candles, and closed candles or black candles are filled candles, which means that, one way to remember it is that a hollow candle will float on water, and a candle that is completely filled will sink. So that way, as you can remember that, black candle is the one that is completely filled and it will sink, which means that it is bearish in terms of prices. And a hollow candle is the one that is going up because it is lighter. Okay, the term white body and black body originated when charts were created using white paper and blank ink. Today, if you actually look at any of the charting platforms, you basically have uh, green for bullish candles and red for bearish candles. I think that comes brings us to the end of this chapter. Let's quickly go to trading view and see a few charts before we come to the x-axis. Just give me 1 second. Okay, there are a few questions in the chat box, so I'll take that before I go to trading view. Uh, so if open and close of the bar is the same, then it will just be a horizontal line. Yes, on a bar chart, it would typically be a horizontal line similar to a doji in a candlestick pattern. How can a doji form on the bar chart? It would just be what we saw. Let me just share the screen again. Uh, if you go on to this one, what you'll see is that uh, something like this would form a doji candle. So this is how it's represented on a bar chart. Again, this one is a doji candle. So you have wicks on both up and down side, but the prices have closed very close to each other. How can a doji form in a bar chart? To cover that, are all bars of the same color? Yes, in a bar chart, it's basically because it's a straight line. It's of the same color when you're presenting it on paper. But if you look at the charting platforms, nowadays the charting platforms are able to change the color of a bar based on whether it's red or green. So if it's something that's moved up, you can see that the bar would have green color. So like this bar will have a green color starting over here, closing over here, but all of them would be in green color. So on a charting platform, we'll see that, and you can actually distinguish whether it's gone up or down. Yeah, thanks, Nikhil, for that. So line chart conclusion, please just elaborate on that question, Jatneshwar. I don't think I understood what are you asking uh, on line charts. Just you can unmute yourself and ask that question. That's fine. Okay, let's go to a few active charts and see. So what you're seeing over here is Nifty, and this is nothing but uh, a candlestick chart. Now, one of the things that you need to remember in a candlestick chart is that it does not represent whether prices have fallen or prices have gone up. So if you look at this particular candle over here, prices actually moved up. So this was the close on the 22nd of November. The close on the 25th, which was a Monday, was actually much higher than the 23rd. But it is still a red candle because the open happened over here. The open happened at the open happened at 24,253 and the close happened at 24,221. The red candle is because of the fact that for that particular day, the open was higher than the close. And because of which this formed a red candle, even though if you compare it from the previous day, the prices moved up. Okay, so that's one thing that you just need to be aware when you're looking at the color of the candles. Similarly, if you look at on this day, okay, the price closed over here, and the next day, was a Thursday, the prices actually opened at the bottom of this particular candle, the body of that candle, and went up over here. So even though this candle was a green candle, but the market actually fell when we compared it to the Wednesday close. So that's a typical candlestick for you. In TradingView, you can also look at other candlestick types. One is the line chart, which is nothing but just plotting all the closing prices of each day, and you can still take your head and shoulder patterns over there and see what is it is telling you. You can also look at other uh, you know range bound activity. You can look at I would say what we call that uh, trend, and you can also look at support and resistance levels. You can do the same things that you would do typically with any chart. You can also look at let's see bar charts. Yeah, this is what I was looking for. So while the bar charts would have your red and green color, but which the softwares are able to do nowadays, but if you look at it on paper, typically your left and right tick would tell you where the open and close were, rather than the color of that particular bar. And what you'll also see is that a lot of Western traders still use bar charts as compared to candlestick chart, because candlestick technique was something that was only made popular in the West in the 1990s, after Steve Dyson published his book on candlestick charting. And a lot of people have switched to that, but some of the older traders still continue using bar charts. So they don't really use uh, any other form, any other candlestick patterns. Okay. Any questions till now? What is the difference between line chart, bar chart, candlestick chart, which is more effective? It really depends on your comfort. The data points that are shown on all of them are similar, except for the fact that the line chart only has one data point per day. Bar chart and candlestick charts have four data points, which is the open, high, low, close. Which is more effective is really a matter of preference. Okay, if I'm not somebody who is looking at intraday movement, I can live with a line chart also. Okay, and I'm just probably uh, taking a long term view. Line chart is good enough because I don't really care about what happens on each day. But if I'm using intraday movements, if I'm trying to look at certain chat patterns where bar chart and candlestick chart should be more effective. And again, some of the Western traders are are better off looking at bar charts. Some of the traders in the East who use candlesticks, they're more comfortable using candlesticks. So that is more a matter of preference, really not about effectiveness of the chart patterns. And then there are other chart patterns, point and figure, Heiken-Ashi. People use Renko charts also. So people are more comfortable depending on what is the chart pattern that they use. It's really about what gives you the comfort to be able to predict prices. Can you explain the gap between the closing of the first candle and the opening of the second candle? Okay, let's quickly go back to TradingView. Okay, and again, I'm more comfortable with candlesticks, so I'll stay with the candlestick chart. Now, uh, if you could elaborate on the question, just elaborate on the question if I've not answered exactly what you're asking for, but what I understood is that you're asking about this particular gap that is there. Okay, now the candlestick does not really care about what happened yesterday. Okay, the candlestick is formed based on the prices of that particular day. So all that the candlestick is looking for is where did the price open. So in this particular case, it opened over here at the bottom over here. It closed over here, and that is why it is a green candle. Over here, if I look at the fact that hey, the prices closed above where it closed yesterday. Yesterday it closed 23,900. Here it is at 24,200, which is higher. It should have been a green candle, but it is red because the open was higher and the close was lower. It only takes into account the price movement for that particular day and not for the fact that how it has closed compared to the previous day. So even though the close over here was probably about 300 points higher. But just the fact that the market opened probably 330 points higher and closed 30 points lower for that day, okay, this particular day, the color of that particular candle is red. It does not care about what happened the previous day. It only looks at the fact that today's close, whether it is higher than the open. If the close is higher than the open, it will always be a green candle. If today's close is lower than the open, then it will always be a red candle. Okay, it only takes into account today's prices to be able to figure out the color of the candle. Okay, if there are no other questions, then we'll move on and go on to x-axis, which is the next chapter. Okay, perfect. So we'll do x-axis and then we'll stop for the day, and we'll take on y-axis and the next chapter, which is on open interest and volume, in the next class. So what is the x-axis? X-axis typically is nothing but the left-hand side of the chart, okay, which is the bottom of the chart, not the left-hand side. So there are different things that can be represented on the bottom of the chart. In most cases, what you look at is the time frame. Okay, at the bottom, you'll have either the number of hours, or it would have number of days. It would have seconds. If you're looking at a 1 second chart, it can also have minutes. So really, what the bottom of the chart or the x-axis tells you is the fact that what is the time frame that the chart is based on. Okay, now given the fact that charts are fractal in nature, okay, if you remember what we discussed in the previous chapter, fractal is nothing but the fact that patterns will repeat over all time periods and they'll behave in a similar manner. So if you're looking at a daily chart, you're looking at a weekly chart, you're looking at an hourly chart, if there is a particular pattern, it would behave the same way on a weekly chart, it would behave the same way on a monthly chart, it would behave the same way on an hourly chart also. Because of that, if you understand a particular pattern, if you trade a particular pattern, you can trade that in a very similar manner, whatever is the time frame at the bottom of the chart. Okay, so if you're trading on a daily basis and you see a head and shoulder, okay, you'll still be able to trade it for a breakdown. Okay, if you're on an hourly pattern and you're seeing a rectangle formation, you'll still be able to trade it the same way that you'd see a daily rectangle pattern. Okay, so the key is that because the nature of the charts are fractal, okay, whether you're using a daily, hourly, weekly, monthly, whatever chart time period, as long as you know the basic methods of charting, you can apply the same tools on very short term trading as well as very long term trading also, or even in terms of investing. Okay, so you can choose any time frame, you can choose any uh, product that you want to trade, and the chart patterns will behave in the same manner. Okay, the key is that as long as you understand how the pattern behaves, you can trade any particular time frame, you can trade any particular security, even bitcoin. So somebody who is a fundamental investor, they might not be able to trade bitcoin because of the fact that bitcoin does not have any fundamental basis. But because we are trading chart patterns, what you can see is that chart patterns are similar across different securities, including bitcoin, which might not have a fundamental basis in itself. Okay, and similarly over here you can see that there's a long range that was developed, and as soon as it broke out of the range, the movement upwards was quite steep, and then small range over here before it broke down. So again, there are times that a particular security will stay in a range, but there will be a higher amount of time that it spends trending, whether upwards or downwards. Okay, so now this particular this particular chart is on the daily time frame. Okay, and you can see that there's a lot of zigzag movement that happens. Okay, this is March 2020, again the COVID time period, and then since then it's broken out and it's moving up. So this is on the daily time frame. If you go to the same chart on a weekly time frame, what you can see is that again the weekly time frame also shows you a little bit of a rectangle pattern where the price was in a range, and as soon as it broke, it started moving up. Same thing during COVID, March 2020, that it fell and then has been rising since. So whether you're looking at the daily, weekly, and then I think there's also a monthly time frame over here, where you know you can actually see that even on a monthly basis, the patterns are similar. It's just that you're looking at it uh, at with a different lens. Okay, the prices fell in March, and that's why it started going down. But the difference is that it is only tracking the last price of each month. Over here, it is taking one data point for each week, and here it is taking one data point for each day, and which is typically the closing price. So irrespective of what time frame you're using, what what is the type of tool you're using, whether it's a line chart, bar chart, candlestick chart, all of those, depending on the time frame, depending on the kind of trade that you want to take, all of them provide you similar information, and you can depending on the time frame of your trade, you can look at what is that you want to trade and for what duration. Okay, analysts who are looking at the long term movement of Microsoft are concerned about the general direction of the price movement over the past several years, and not whether the stock opened higher or lower on a particular day. But if I am trading an intraday strategy, then I'll be very interested on whether the market has opened or closed at a particular level, because that is where I'll make the money. But somebody who's looking at it for several years, they don't care about one day movement in the Microsoft price. Similarly, if you look at the intraday movement, okay, now this is a 10-minute candlestick pattern, okay, and this is only for one day. Okay, so at the bottom you can see these are 10-minute intervals that have been plotted. At the bottom, which is the x-axis, you're seeing the time frame over which this particular chart is plotted. Okay, now each bar over here represents 10-minute data intervals. Okay, now the body shows the open and close. Anybody who can tell me whether on this particular bar we closed lower or closed higher on this black bar? Anybody?
Lower, lower, I
Okay,
guess.
lower, right? So white bars are the ones that are showing that the markets have moved up. Black bars are the ones that are showing that the close is lower than the open. Okay, so over here, this was the open, this was the close. Okay, but over here, the white bar, this was the open, this was the close. So just remember that, because sometimes in the exam you might get a black and white depiction. You can also get a red and green depiction, which is usually easier, but you need to understand, what is it that a black bar and a red bar is telling you. So each one of them is a 10-minute bar. One second. Some questions in the chat box. Okay, perfect. Yeah, a lot of people saying lower. Yes. Uh, can you explain the gap? Okay, so there are no trades taking place. Uh, in the span time of during the gap. Uh, Aditya, it can be that there are no trades that have taken place during that time. So typically, what happens is that if you look at it from the time point of view of the daily chart, what has happened is that, so suppose over here this is the close, okay, on Home Depot, but there have been some news or events because of which the next day it opened with a gap up and it opened somewhere over here. So typically on the daily chart you will see gaps. On the intraday chart you'll see fewer gaps, but can there be gaps on the intraday chart? It can, they can be. So suppose over here there's a news that comes in for Microsoft, and it directly opened over here even in the next minute, and it can happen if you see a lot of commodities, etc. Every time that there's open on the US commodities trading desk or European commodity trading desk, the prices typically jump. In most cases, what will happen is that if the prices have to go down, then you'll see a long candle over here with a big body or a big wick. But sometimes what can happen is that the price close over here, just the next minute, because the a different market has opened, the price will open directly over here. So it does not mean that there's no trade that is taking place, but basically the next trade has taken place much at a much lower point than the previous trade, and there's no trade, in a way you're right, there's no trade that's taking place in between. So today the price closed at 100, tomorrow it might have opened at 110. Okay, any questions till now? Okay, so so yeah, we just completed Microsoft. Hmm. I think I'm missing this particular chart of DJI and S&P. Uh, but let's keep going. Let's look at a similar chart for Apple. Now, over here, what they're showing is a monthly line chart from August 2016 to 2020. Now, what you see over here is that each of the data points over here are just 1 point in terms of a month. Okay. Now, a line chart with monthly closing prices. Okay. So, all that you're seeing is where is it that Apple closed in the month of July? Okay. Where did it close in the month of August, September, October, something like that? And then the fact that it just jumped up from here to here. Now, while it is something that is good for us to see that, hey, the prices are rising, but not necessarily something that we as analysts can use to track the movement of Apple's share price. Okay. At that time, we need to be able to look at it in terms of both candlestick patterns, because the candlestick actually tells us that within this month, the prices opened over here and actually closed down over here. Okay. In this month, it opened over here, okay, and it closed over here. So these are the months where the prices opened lower, closed much higher, opened lower, closed much higher. So even though if you do a line chart, it would probably be the same one that we saw earlier, but this gives us much more information in terms of what the stock did. Okay. And sometimes when you look at it, even the fact that there are certain candlesticks that have very short wicks tell us a lot about what the price movements have been. So if you look at these particular uh, candles, and similarly over here, okay, the price opened for the month and there's no wick at the bottom over here. Okay, because there's no wick, it basically shows that the price just kept moving up, it never came down and below. So this is also a very small wick, and as soon as the prices opened at this level, it went down, but it went up very quickly. And these months don't have any wick. A lower wick, sorry, a smaller wick on the lower side shows that there's higher pressure for the prices to move up. Okay, even over here, you don't see a wick, which means that the prices have been moving up month on month. And in most cases, because there's no upper wick, it shows that the prices have closed at the high point of that month. It's not that the prices went up and then came down and then closed over here. Okay, in which case you would have had a wick on the top, you might not have had a wick at the bottom. Okay, so the prices have just kept going up and then closed at the high point of that particular month. So over here there's a very small wick. Over here there's no wick at the top, which means that the prices actually closed at the top for that particular month. Okay, it's not actually gone down. So the difference between looking at a line chart, which is like this, versus a candlestick chart, the same thing can also be done with the bar chart, is that you get more pieces of information in the bar chart compared to a candlestick chart. And that is why when you look at it, you're able to make more inferences when you're using a candlestick or a bar chart compared to a line chart, because you have fewer information points. So in each of these cases, over here there was no lower wick. Over here, you know, there's no upper wick, which means that the prices closed at the high for that particular month. Okay. Over here, there was a very long wick at the bottom, which showed that the prices did go down, but at the lower places. So somewhere over here, there was a lot of buying that came in, which pushed the prices back to be able to close at the higher level. Okay, so the prices ultimately closed over here. It still fell, but closed over here. It still fell. Okay, because it is a black candle. It still fell for that particular month, but there was a lot of buying that came at the lower levels, which would typically be a bullish signal. Similarly, anybody who can tell me what is this candlestick pattern? Anybody?
Hammer.
Shooting star.
It's a hammer. So shooting star typically happens at the top, where it's a similar pattern, but it happens at the top, where the prices have moved up, and then you have a shooting star, and the prices start moving down. This one typically happens at the bottom, and it's usually a very strong bullish signal, where if the next candle closes above the high of that particular hammer, then you can take a trade in the bullish direction or the upward direction. So that's the kind of information that you get by looking at the chart. It gives you a sense of whether the prices will move upward, whether the prices will move downwards. What is it that is happening? Is there pressure in terms of more buying that has come in at different levels? You know, no big basically shows that the prices have on the lower side prices have kept moving up. On the higher side, it shows that the prices have closed very close to the top for that particular day, week, month, whatever period that you're using. uh, can it be called as a pin bar? Yeah, probably it can. I don't remember the exact definition of a pin bar. I'll probably check and come back to you in the evening class. But yeah, because I don't use a lot of chart patterns, there are a few that are eluding me right now, but I think it can be called a pin bar, but I'll confirm that later on. So charts which depict a single bar, charts in which a single bar depicts a long period of trading, such as a month, are good for knowing what the long term trend is, because in a way they cancel out a lot of the daily noise that comes up. So if you're looking at the daily chart, you'll see prices went up, uh, you know uh, and closed in a very narrow range. But this will create a lot of noise on the daily chart because the wicks are very large. But the monthly candles tell you what is it that the price is actually doing. Okay, it if you look at this weekly chart, even this would show you that the prices are moving up, but it will have a lot more noise in terms of the fact that the prices have moved up or down, whereas a monthly chart will show you uh, a similar data, but taking out a lot of the noise that is there on the smaller time frame charts. So if you even look at a hourly chart, what will happen is that the price might have moved like this, but if you convert that to a daily chart, this is the open and this is the close. You just have these two data points, and you don't have all these intermediate movements of up and down on that particular chart. So if you look at the weekly chart of Apple over here, okay, a lot of the increase came in July, and within July, it came in the last week of that particular month. Okay, so where's July over here? Okay, over here, and then this is August. So if you actually see, this is where the maximum price movement happened. This white candle, and that's what they're saying is that while there was a large price movement in July, a lot of that happened in the last week of July, and that was the big candle that is there over here. Now, uh, Apple has ended each of the last 2 weeks lower from where it started. Okay, so if you look at it, these 2 weeks, it actually ended lower. And in September, okay, the first week in September has an extremely long top and bottom shadows. Okay, which is this one over here. The month of September, even though it's a black candle, it has a huge wick both on the upside and the downside. And what does it tell us? That there's been huge price movements in both directions, even though the close is in a very narrow range. Okay, so as you go lower and lower in terms of the time frame, you'll be able to figure out how the prices have moved. But at the same time, you also need to be aware that what is the information that these prices are telling us. Okay. Now, if you look at the daily chart on those, it then shows you how the prices have moved in the month of August, how it's moved in the month of September, and these large black candles and this candle with a huge wick, that kind of tells us that okay, for the 6th or the 7th of September, the prices moved down significantly before closing upwards. And these are the daily candles that are there on Apple. So typically, whenever we look at any data points, what we try and do is look at what has happened over the long term, and then try to bring it down to shorter time frames in terms of our trading. So the daily chart shows the progress of how prices went through the week. On Monday and Tuesday, the prices went up. Um, I don't know which time period they're talking about. Uh, and then the price continued upwards on Wednesday. Uh, on Thursday, the stock opened at an approximate low of the previous day. Okay, let me probably just figure out which days they're talking about, but I think we're on top of the hour. Okay, so we're basically looking at the Apple chart, and what we had over here was this 1 week in Apple that had a huge price movement. The last five candles in 2.2.8. Okay, so this is 227. If we go over here, this is a weekly candle. Okay, so this is the weekly chart of Apple. If you look at 228, that is the daily candle, and that kind of shows the price movement for that entire week. So 1 week where the prices actually went down, but there was a huge volatility in the prices, which you can see in the wicks, the upper and the lower wicks. The price really moved from 110 probably all the way to above 130, probably maybe 138, 139, and then closed at the lower end of the spectrum in terms of the price movement. So if you look at the next particular slide, what happens is that 1, 2, 3, 4, 5. These are the 5 days, okay, uh, that has been depicted by this one bar. Okay, this one bar, because it is weekly, it shows the 5 days of movement. So the stock actually opened over here, went up all the way till here, okay, and then went down, okay, and then closed somewhere over here for the week. So what we're seeing in the previous bar is the same thing. The price opened over here for the week. Sorry, yeah, opened over here for the week, went up, went down, went up again, and closed somewhere over here. Okay, so if you look at the monthly charts, you look. Can you please conclude this class early as the India Pakistan match? Okay, yeah, I don't think we have a lot to cover for this particular class, so we'll see how quickly we can end that. That's fine. Uh, so yeah, having said that, just to reiterate, so the last five candles in the next figure basically shows us what this one candle shows us over here. Typically, when you look at any trend, you look at any movement of the prices, you'd want to go from top down. You want to look at what is happening on the monthly and then break it down and see what is happening on the weekly and then daily. So if you are using the daily bars, typically if you look at uh, when you're going from one time frame to another, so typically a ratio of 4 to 6 is ideal, which means that if you're looking at an hourly bar, okay, then you progress to a weekly bar, sorry, daily. Okay, daily would be approximately 6 hours of trade. Okay, daily to weekly would be about five daily candles. So typically, when you look at moving from one time frame to the other, you typically look at a 4:6 ratio of your short term versus the long term bars. Okay, so just make sure that when you're doing that, you don't have uh, your monthly bar and and then you go directly to a daily bar, because here you have about 22 bars moving from daily to monthly. But if you go from monthly to daily, you have probably about 4 to 5 weeks that would show up in 1 month. So that's again not there in the book, but I just wanted to share that with you. Whenever somebody is looking at multiple time frames, they look at a ratio of between 4 and 6 for converting from a short term to a longer term chart pattern, and then vice versa. Any questions till now? Okay. So till now, what we've seen that your x-axis actually incorporates the time. Okay, so whether it is hourly bars, whether it's a minute bar, whether it's a weekly bar or monthly bars. But now what we're seeing is that the x-axis has changed from time to activity, and we call this activity-based interval. So the first one that we're looking at is a volume scaled bar or volume bars. So what happens over here is that instead of saying that okay, this one bar is a 5 minute bar, what we're saying is that this one bar contains a certain volume. Okay, in this particular case, 1 million shares of Alibaba that is being traded for each bar. So if you look at this day versus this day or this day, yeah, even over here, you can see that the number of bars are fewer over here. The number of bars are much larger over here. What this depicts is that each bar is 1 million shares that are being traded. Okay, this small bar over here is 1 million shares. This tick is the opening, this tick is the close. So there was very little price movement because the opening and the closing price, as we, uh, you know, as you go back to the bar chart that we studied in the morning class, the open and the close are depicted by the left and the right ticks. Okay, so this is the close, this is the open. If this is how the prices moved and this is where it closed, then this is how it will be depicted with the highs and the lows. So over here, each bar does not represent a period of time. Till now, what we've been doing is that, okay, this bar is a daily bar, this bar for Apple is a weekly bar, this bar for Apple is a monthly bar, and at the bottom, you'll have time mentioned. So over here, this would be 21st of September, 22nd, 23rd, 24th, 25th. But when we come to activity-based charting, we don't really care about the time. Okay, while time is mentioned on the x-axis, what we're looking for is what is the volume that's been traded on a single bar. Okay, so over here, the difference is that it calculates one bar or one candlestick for a certain number of shares, and you can change the number of shares that you want to take into account. So for Alibaba, which trades a lot, you know, in a day it might be trading about 10 million shares, so you'd have 10 bars. If it is trading only 5 million shares, then you'd have 5 bars. But for some stock that is only trading suppose 50,000 shares a day, you'd probably want to keep 5,000 bars as the benchmark for creating one single bar during that day. But what does it tell us? If you look at it, what will be the time frame we need to look for selecting stocks for swing trading? I mean, hourly, daily, weekly, monthly. How many confirmations do we need to pick a stock? Okay, let me just complete this and I'll come back to that question. So, what we're saying over here is that for each bar, whether it's a small bar or a large bar like this one, there are 1 million shares of Alibaba that is being traded. But what you see at the bottom is not really a time scale. Okay, they mentioned the dates. So this is the start of, or this is the close of 311, or maybe sorry, this is the start of 311. On the 11th, it had approximately, let's see, 1 2 3 4 5 6 7 8 9 10 11 12 maybe, so 12 bars. Okay, which means that approximately 12 million shares were traded on that day. But if I look at this, this is 1 2 3 4 5 6 7 8 9 10. So on this day only 10 million shares were traded. Okay, so the number of bars that are there is a reflection of the amount of activity or the volume that is being traded for that particular share, and not a reflection of the time that it has taken. Okay, there can be just one bar in a particular day, open, goes up, closes over here. That means that on that particular day, only 1 million shares of Alibaba was traded. And sometimes it might even be lower than 1 million bars, because typically that bar would close for the day. And you'd probably have only 900,000 shares traded. But the difference between what we've learned till now to activities based bars is the fact that activity based bars really talk about the amount of, or the volume of shares that have been trading, versus the time based bars that we've seen till now. Okay, let me just see if I can get that on trading. We haven't used a lot of time based bars, but let's see. Okay, I prefer to go on Nifty futures, and let's see what we have for here. Mm, no, they don't necessarily have volume based bars over here. High low volume footprint. No, no, that's different. Kagi range is something different again. Renko Hakinashi. So TradingView does not have this, and I'm not sure how many people use that. This is volume candle. What happens is that the width of the candle really depicts higher volume days, and you can actually plot volume at the bottom and see what is happening. And this is 4th of June. Can anybody tell me what this candle is and why there's a higher volume and this candle is thicker than all the other candles?
Election day result.
Yeah, so that's the result day for the election, where there was a lot of trading that happened, and that's why. Uh, Now, this is not exactly what we're talking about over here in terms of volume scaled bars, but what this is more like a volume bar. So the thickness of the bar shows you the amount of volume that has been traded. So if you look at it, this bar is actually thicker than some of the other bars, and especially the days where there's less trading, these bars will be thinner, and the days that have more trading compared to the average, then you'll have higher, thinner bars. I don't think they have uh, exactly what we're looking for, but some of the other charting tools might have that, where the bar is constructed not based on the time, but it is constructed based on the fact that X amount of volumes have been traded on a particular day. Okay, I'll go back. Any questions that anybody has? Yeah, Harsh. So unfortunately, it's not there on TradingView, but basically what you need to understand is that uh, this bar really shows the amount of activity. So on the days that where you have a large number of bars, it just shows that there is a lot of volume that's being traded, versus days that have lower number of bars. At the bottom, while there is a timestamp that is mentioned, but it might not come in the right sequence. So it would provide you a timestamp only once 1 million shares have been traded for that particular stock. But if you look at the rest of it, what you'll see is that it has the same open and close as a normal bar chart. And what the open and close tells you is that this is the time, or this is the price where the first share was traded, and this is the price at which the 1 millionth share was traded. Between the first trade versus the millionth trade, the prices have moved in this particular range. This is the high, this is the low, and close, open. So if the tick is on the left hand side, that is the open. If the tick is on the right hand side, that is the close. But each bar represents about a million shares that have been traded. Now, in the previous one, we saw volume. Okay. But there's also another term that is used uh, in finance or in the market, which is called a tick. Now, tick represents a number, the number of trades. Okay, now what's the difference between a trade and a tick? So suppose I want to buy 100 shares of Reliance. Okay, what do I do? I go ahead and place a limit order saying that I want to buy Reliance at 1200. Okay, and I want to buy all the 100 shares at this 1200 price. So what will happen is that this one order of 100 shares will be a single tick. Okay, but the volume that we were chasing or we were plotting over here, the volume will be 100, but the tick will only be one because I have placed just one order for the entire 100 shares. But if I split this into 50 shares at 1200 and 50 shares at 1195, then what happens is that this will be two ticks each of volume 50. Okay, so a tick is a single transaction regardless of the volume of that particular transaction. Okay, so these are tick bars, and what it does is that in the previous uh, bar, which is volume scaled bars or volume bars, what we are looking at is the number of shares, which is the 100 in our case. Over here, we are looking at the number of orders, irrespective of the volume. So if there are 5,000 orders that are being plotted, those 5,000 orders can have a million shares, they can have 5,000 shares. Okay, because here we are plotting tick by tick rather than the actual volume of the bars. Okay, but do remember this difference because there are times that it is asked in the exam, the difference between a tick bar versus a volume bar, or they might give you an example and say that is this a tick chart or is it a volume chart? Because the difference really is that tick is the number of transactions, okay, and the volume bar is the actual volume. Okay, you can have one transaction with 10 shares, you can have 50 transactions with 50 shares, which means one transaction per share. Whereas in the first case you have one single tick but the volume is 10. Over here you have 50 ticks with the volume of 50. Questions till now? Okay, so at the bottom of the screen on the x-axis, it works the same as what we are doing on the volume chart. Each tick over here is 5,000 transactions. So each time there are 5,000 transactions that are complete, you will see one tick or one tick bar that would come up over here. The open and close remains the same. So over here, this would be the open, this is the close. Okay, but this is the open and close for those 5,000 transactions. Okay, these are the 5,000 trades that have been taken on days that you do not have a lot of volume or a lot of trades. What will happen is that you'll have fewer bars like this particular day, but on the days that you have a lot of volume and a lot of orders really, you'll see a larger number of bars. Okay, and that kind of corresponds to what we're seeing even in terms of volume. So in most cases it will be similar because the average number of volume uh, per trade usually remains the same for different stocks. But what you're seeing over here is one being a tick chart, which is 5,000 ticks, and the other one over here being a volume chart, which is volume of a million shares. Okay, so basically what you're seeing over here is that on an average, probably about 200 shares, 10, 2,000 shares per tick that is being traded for Alibaba. Okay, which basically means that each of those 5,000 tick bar that we see was constituting to about a million shares that are being traded. Okay, so 2,000 shares for each order. That's the average that's coming out based on, if the number of bars over here are the same as the 1 million shares that are being plotted over here. Let me see if there are questions before I move ahead and if you've understood what these two bars are. Very different from what we are used to, but some people still use that because in one glance it shows them that this is a day where there is a lot of movement that has happened versus this per I won't say movement, but a lot of volume has been traded versus this day where there are fewer orders that are coming into the market. Okay, at the bottom the x-axis remains the same. The x-axis will only measure the time when those 5,000 trades have been done. Okay, so if there are fewer trades that are taking place on a particular day, then you'll see fewer number of bars, and the timestamp would be further apart. If there are a lot of shares that are being traded on a particular day, or a lot of orders that are coming through on a particular day, you'll see a larger number of bars, but the time would probably be much smaller. The time interval would be much smaller. Okay, so each one of them represents about 5,000 ticks. Now we come to point and figure
Sir,
chart.
I didn't get the significance of tick bar. I think that tick bar is subset of volume bar. Is it, or what is
Yeah,
the?
in a way, both of them are similar, but the difference is tick is the number of orders. Okay, so if you look at your broker screen, what you'll see is that you will see over here you'll say number of orders, and here you'll see the volume. Okay, and here you'll see the price. So suppose at 1200 you have 5 orders and 100 shares. At 1195 you have 6 orders and 50 shares. Okay, 1190 you have 3 orders and 20 shares. Okay, so this is the what you'll see if you've looked at the screen where you're actually looking at the buy and sell. And similarly, this is on the buy side and this is on the sell side. You'll have a similar thing which will show that, okay, 1201 you'll have a certain number of orders. Tick basically talks about the number of orders. Volume talks about the actual volume that is being traded. So when you're looking at your buy and sell side on, once you drill down onto the order screen of your broker, what you'll be able to see is the buying price, how many people are willing to buy at different prices, and the selling price on the right hand side, how many people are willing to sell at different prices. The sell price will always be higher than the buy price. Okay, because if it is lower, then the system will just take the best price and match the two, and the trade will happen. But if the trades that are pending, this is the way it will show up. So what a tick is showing is the number of orders that are there, or the number of orders that have been fulfilled, and volume is showing the number of shares that have been traded. Okay, I can have one order for 100 shares, I can have one order for one share, and that will show up in the tick bar, which is this one, and the volume would show up in the volume bar, which we just studied. Okay, the volume scale and volume bars are very similar, and then the tick bar basically tracks the number of orders. Okay, but remember the difference between the two, because there are times that question is asked in the exam where you need to differentiate between what is an activity based or a volume scale bar versus a tick bar. Does that help? Yes, no, maybe. Okay, I'll take that as a yes and move on. Okay, so there's a question from Ranjit. What will be the time frame we need to look for selecting stocks for swing trading? Uh, Ranjit, on that one, my response really would be that what is the approximate time period that you'd want to hold your swing trades? Okay, so if you're looking at it as something that you'd close on a daily basis, then people typically look at a 15-minute chart and take a swing trade. If you're looking at keeping that position open for several days, then you'd look at an hourly chart, take a swing trade. And if you're willing to keep that position open for a few weeks, then even a daily chart is fine, because what will happen is that you take a swing trade on a daily chart, and over a period of the next week or so, that position will stay open till the time that either you hit your target or there's a reversal on the daily chart.
So, sir, I mean to say that whether one means how many confirmations I needed. Suppose I want to pick a stock, suppose
Mm-hmm.
Tata Motor. So the
Mm-hmm.
thing is that first I need to see that hourly chart. Then I need to confirmations along with this that apart from the hourly, what the activity is going on daily, weekly,
Mm-hmm.
monthly. So two,
Mm-hmm.
three confirmation I need, or just I will go for a single time frame and I see that okay, if the things setup is allowing, then go for the trade.
Right. Very good question. So if I try and answer that, there's no right way to do it. I typically look at least one higher time frame. Okay, so if suppose the weekly is in an uptrend, then and only then will I take a long position on the daily chart. Okay, if the weekly is in a downtrend, I will not take a long position on a daily chart. Okay, that's the first thing. That the there is a separate chapter. It's 4.4, so you can check the syllabus, Nikhil. I was actually trying to look for that in the morning once I saw this. But yeah, there is a separate chapter 4.4 which is on pointed figures. So I try to make sure that whenever I take a trade on a shorter time frame, it is in line with what the longer time frame is telling me. Okay, it cannot go against the longer time frame because that would not give me a lot of confirmation. Now the confirmation is a little different from your trade. Okay, so if I'm taking a trade, suppose on the hourly time frame, okay, I want to make sure that the daily time frame is going up, only then will I take an upward uh, uh, a long position on an hourly time frame. Similarly, if it is down, if daily time frame is going down, then I only look for downward trades on the hourly time frame, and that just helps uh, make sure that my overall position is in line with what the longer time frame is doing. Now, coming to confirmations, there is always a trade-off. Okay, when I say trade-off, basically, if you try and use, suppose a moving average, you want to use RSI, you want to use MACD, the more confirmations that you have, it's always better. Okay, so you can wait for more confirmations, but what happens is that when you wait for more confirmations, you would get a trade that you have a higher conviction for, but a lot of the price movement has already been done during that time. So it really depends on what is the kind of rules that you're using for your trade to be able to then determine whether it is a trade that you'd want to take or not. uh, I don't know whether all of you have already studied that. So whenever I take a trending trade, okay, whatever that my first indicator is, so suppose my first indicator can be a moving average crossover. Okay, that can be my first criteria, but I always use something called ADX to see if that move has uh, has the right amount of momentum for me to trade that particular move, because sometimes the crossover happens, it goes up and then it goes down, goes up and goes down. In that case, the ADX will be very low, and if the ADX is very low, that basically tells me that the momentum is not there in that trade, and it might just reverse. The moving average crossover might just reverse, and I might have to take my stop. Okay, so I also take a look at, suppose, RSI, and the RSI should not be overbought if I'm entering a long trade. Okay, similarly, if I'm entering a short trade, I'll make sure that the RSI is not oversold. So there's some filters that you can use, but the more indicators that you use, what will happen is that you'll have to give up a larger portion of that move, but you'll have a higher conviction in that trade. Okay, I hope that answers.
Got it, sir. So that suppose in a nutshell, first I will go for the hourly, then either I will select the movement that whether what the daily, weekly, or monthly is going on. Then
Correct.
along with the hourly, if either of the two is going positive, then I can go for trade, sir.
Correct. So I won't go to the weekly chart for the hourly, but yes, the daily should be going up for me to take an hourly trade in the upward direction. And similarly, so basically the next higher level, which is the 4 to 6 ratio that I told you, it's not in the book, but that's what most of the traders use. you take the next higher time frame. Okay, so in the case of hourly to daily, it's typically approximately 6 hours. If you're taking a trade on the daily time frame, then you look at the weekly chart and then say that the weekly should be going up at least for you to take a long trade.
Okay, sir. Got it. Thank you, sir.
Perfect. So point and figure chart, you will study a lot more of this in 4.4, but over here, what we're just trying to study is what is a point and figure chart. Okay. Now, till now, what we've looked at are charts where there is some amount of time that is plotted at the bottom. Okay. So whether it is time for an activity or the time duration, okay, whether it's weekly duration or daily or monthly, whether it is the volume or the number of ticks. But over here, there's nothing that is there at on the x-axis. Okay, you cannot define time. There are some charts that tell you, okay, this is the day that this particular bar started. This is the day that this particular bar started, but that can be completely random. What is a point and figure chart? Okay, now over here, the point and figure chart actually only plots the price changes. It does not care about how long it takes for the price to change. Okay, how does it work? So typically, point and figure chart, suppose this is one x. So x basically shows that the prices are going down, and if there's an o, sorry, x represents prices are going up and o represents falling prices. Okay, so wherever you see an x, okay, here the prices are rising, here the prices are falling. But it's not like it will show a X or a O for each and every price rise or fall. There is a minimum box size that the prices should move for a new column to be created. Okay, so let's take an example and see what happens. So one particular stock is going at 100. Okay, now I want to create a new box for every 3 rupees movement on this particular stock. So suppose, or let's take the example over here itself, 63, and then O is greater than 62. Uh, Actually, no, let's stay with our example, and then we'll come to this one. So now, if the price has gone to 101, okay, at 100, we have, suppose, an X over here, which is where the prices are rising. 101, there's no more X that will be created. There will be no more zeros that will be created. At 102, nothing will happen. 103, there'll be another X that will be created over here because the price has moved by an increment of 3. Now, what happens? The price goes to 106. There'll be another X that will be created over here because our increment is for every 3 rupees movement in the price. Okay. Another X, probably the price has gone to 112. Now, if the price goes from 112 to 110, okay, what happens? Anybody? If the price goes from 112 to 110, what will happen?
Nothing will,
Nothing.
sir. No
Nothing.
changes will be there.
Right. Nothing
We,
will happen because the change is not more than 3
three.
rupees. So
Yes.
as
Three
soon as the
point.
price goes to 109, you'll have a zero that will come up over here. Sorry, at over here. There'll be nothing over here. Okay, because this is 112. Okay. Now, as the prices start going down, 106, there'll be another zero that will come over here. 103, there'll be another zero that will come over here. Now, till the time the prices keep going down, they'll all be in one single row. There won't be a second row that will be created. A next row will be created. Suppose this is at 90, this point. If the price moves above 93, then you'll have an X that will come up over here. Okay. So what a point and figure chart does is that it only plots change in the prices. Okay. There's no time scale at the bottom over here. If you go on trading view, I'll show that to you. You will see a time, but the time will only tell you when this bar started. Okay, and that too, it's not relevant for most of the research because that time is immaterial. It is only tracking how the prices have moved whether the prices have changed in one direction by more than a certain threshold or not. And a new column will only start if the prices have changed by more than a certain amount. So what's happening over here is that analysts are not plotting a series of price observations at equal time intervals. All that they're plotting is whether a prices moved more than a certain threshold or not. A larger box means larger price moves must occur before something is plotted. So instead of 100 and box of 3, I can also do a box of 5. So what will happen is that if price has gone to 103, even to 104, I have 1x over here. There'll be no further x till the time the price crosses 105. Okay, that is where I'll plot an x. Okay, and then if it crosses 110, I'll plot a second x. So depending on the size of the box that I want, there'll be fewer number of columns and fewer number of x and o's, versus if your box size is very small. Okay, you can even keep this box as 1. If the box is 1, then as price moves from 100 to 101, 102, 103, 104, you'll have multiple x's. But from 104, if it's gone to 103, you'll have a row of zeros, a column of zeros. Okay, so it's gone down to 102, it's gone to 103, 104, 105, 106. So for each and every change in the price of that stock, even by 1 rupee, what will happen is that you'll have a new column that will be created. Okay, so depending on the box size, you can figure out whether there's a large price movement or not. Increasing the box size reduces the amount of noise. Okay, what we discussed earlier, that noise is nothing but uh, movements in the chart. If you increase the box, okay, then what you'll see is that probably the prices are just moving in one direction. It's gone from 100, it's gone to probably 105, it's gone to 110, but in between this, it's gone to 101, 102, 100 again, 103, 104. So all this will not be captured if the box size is 5. Okay, but this move will be captured if the box size is 3. So if the box size is only 1, you'll capture all these different moves. Each and every 1 rupee move will be captured. So typically, if you look at most of the charting platforms, they use ATR or a multiple of ATR as the box size. Okay, just easier. You can change that box size to a dollar value. You can change that box size to whichever way you want to construct those boxes, and the chart will then depict more noise or less noise depending on how you've constructed that chart. Okay, typically it is called a 1 into 3 point and figure chart, because typically most people use a 3-point movement to go from one bar to the other, which means that if your price is at 100 right now, a 3-point move either to 97 or to 103 would only help you create the next X or O. So if the price goes to 97, you'll create an O. If the price goes to 103, you'll create an X. The X axis is not relevant in a point and figure chart because time is really not measured. All that we are measuring is what is the price movement. If the price has moved by more than 3 rupees, then you'll create the next X or O. If the price has not moved by more than 3 rupees, nothing will happen on the chart. Let's go to trading view and see how the point five figure chart looks. Yeah, Ajita, this chart is actually used by a lot of traders, and most of them have the same characteristics that we see in a normal chart. You can create support, you can create certain patterns, etc., and that is something that's covered in 4.4. And Soviet is probably a better person to explain that to you. And but a lot of that is already covered in one of our for the chapters. Now over here, let's go to the hourly chart, and here's what happens. Now, if you look at this, let me just see where is it that you can change. Oh, I'm just trying to see where is it that you can change some of the parameters. Uh, okay, point and figure chart. Uh, it is taking the ATR on 9 and 3, but I'm just trying to figure out there was a way. I don't use this chart so frequently, so I'm just trying to figure out. Uh, yes, it is used in real life, and a lot of traders actually use that because it kind of takes away the noise from the system. So only when the prices are going up would you take the next trade. So typically, if I were to look at this particular chart, and this is for gold, I will draw a line like this from here to here. Okay, and as soon as price breaks this line, okay, that is when I'll take the trade. Okay, so the same kind of patterns that you see in normal charts you would want to use in the point and figure chart. So you'll take this trade, you'll go up till here. Once a red zero comes up over here, that is where you'll probably exit uh, this particular trade. Why am I not able to see? Hmm, let's see. uh, I know there was a way to change it. If anybody has an idea, just let me know. We can come back to this. Mhm. So right now it's taking 14 period ATR, uh, and then 3 standard deviation and $9, and 3 is basically 3 times of $9. So 9 is 1 unit, uh, and if the price changes by $27, that's when it will plot the next uh, either X or O. But I'm still not able to figure out how do I change this 9 and 3, because you can change that. Which
Sir, I think that ticker gold spot we are getting that three dot line. If you that
over here,
on tick no on ticker, if can you go last three dot line, three
okay.
dot line, and I think in the settings we can as if
It's giving me the chart setting and not the settings for this. Okay, over here.
it
Okay, thank you.
yes.
Okay, so if I change the reversal amount, if you look at this one, okay, what you'll see is that if I change this to 1, there'll be a lot more zeros and X's that will form up over here. Okay, so basically what I've done is that I've changed the reversal amount to just one time of the ATR. Okay, even if I change the ATR period from 14 to 7, that will change because now there'll be more lines that will come up. Okay, it does, and I can probably remove uh, the uh, session break. Okay, if I remove the session break, you'd not know which is the day on which these were formed, right? So what it basically does is that you'll see a lot of change in direction, because one, I've changed the ATR to 7, which is much faster in terms of the turnaround, and then the number of or the multiples has changed from 3 to 1. So let's go back, and I change it to 14 and 3. Okay, so if you just look at the number of bars that are there in August, you'll see that the number of bars will certainly change and become much smaller. Okay, so July to September, there are only so many bars, even though we had much more bars just between July and August when we changed those parameters. So what you can do is, depending on how quickly you want to change your trading direction, you can change this number. And what you can see over here is that there are more bars that are now being formed between August and September than when we had a parameter of 3 over here. Okay, so now suddenly July to September has much fewer bars, and you can see that the scale has completely changed. Okay, so that's what this is about. there is a new bar that is formed every time the price reverses by a certain amount. Okay, if it does not reverse by that much amount, then things stay as it is. And typically, people who are doing trend following or people who are even doing breakout trading, what they would do is they would use this and then decide whether you know they can play for a breakout or not. The same things in terms of support and resistance lines work even on a point and figure chart. Okay, I'll stop over here, see if there are any questions before I move to the next section.
Sir, can we see the present trend of Nifty in point and figure chart? That what the strength of Nifty say in the present moment?
What do you think it will say?
So by plotting the
You tell me. I think by now you know what the Nifty direction is, right? Okay, let's take a look at it anyways. Okay. Now this is on the daily. Okay, and even if I plot hourly, the trend is downward and it broke down in September. So this is 30th of September is when the first red tick came in. 9th of October, it showed a little bit of an uptrend that was very quickly broken. So for somebody who's trading on point and figure, they would look at this upward move, they'd look at this downward move, and as soon as this is broken, that is when they will take a short trade, ride it till over here, which is still about, if this is where you entered, this is still about 800 points. And as soon as the first green bar comes up, you will exit that particular trade. Okay, so you probably get about 600 to 700 points on this particular trade. And again, once this is broken, you take this trade, and on the first green bar, you exit. Okay, and depending on what you're playing for, so you probably draw a line over here, which is breakdown of the support. I think this would be November and December. Yeah. So over here in December, the market actually moved up. So if you go to your normal charts, okay, and if I look at weekly, so there was a little bit of uh, up move. No, so not is it December or probably November? Okay, November there was a little bit of an up move, and then it broke down again in December, right? So and these are weekly charts, but if you go to your point figure, you can actually see. I'm using the hourly over here, but it clearly shows that there was a little bit of an uptrend in November, and then it broke down again. So if you had a trend line over here, and if you played for the breakout of the trend line, you could have captured this downward move, probably exited over here, entered again over here, but taken a stop loss. But again, if you entered somewhere below this particular thing, you could have, gotten another 600 points or probably 500 points because, you wouldn't have exited till the time the first green X came up over here. So in the current context, I would say that it seems that 22,800 is has been broken, and even the point and figure chart shows that the next uh, O has been formed below the support of the previous bar. Okay, but wait for it. Once you do 4.4, then Soviet will be able to explain you point and figure chart in a much better manner, and because he uses point and figure chart, and he'll be able to explain to you exactly how you can use it for trading. Okay.
so sir, the moving indicator, EMA, etc., can be plotted in the same way as we are plotting in this candle chart.
Not the indicator, but you can use your normal support resistance. You can use your triangle patterns. You can use the patterns. You can use support and resistance, but not necessarily the moving averages or some of the other indicators, because moving average really works on time. Okay, you have the last 20 period uh, price, which you will plot as a moving average, which you would not be able to do in this particular case.
Got it, sir. Got it. Thank you.
Okay. Uh, for point and figure, define its software gives clear view in percentage terms, but in trading view, there's no setting to change to percentage terms. Good point, Hemant. Let's quickly go and see. Again, I don't use that so much, so uh, but yeah, I think let's go and see what happens over here. So 1 hour and change it to point and figure. Go to ATR and let's see. Over here, you can actually take percentage also. So even point and figure can uh, show up as percentage in trading view. So you can change this from here. Box assignment is not only ATR or percentage. You can also actually take an absolute number, and you can change this to a dollar value or a rupee value. Okay,
Sir,
but the
how can
default is ATR. Thanks. Okay, let me just share my screen again. Perfect. Any further questions just in terms of how the point and figure chart is plotted? Okay, when you go to 4.4, you will you will be able to see how you actually trade point and figures, and there are multiple ways in which you can trade point and figure. There are also ways in which you can not only trade, but you can also figure out based on certain horizontal and vertical calculations what is the target that you'd want to put in based on the point and figure chart. Okay, so the next one is really something called range bar. Okay, range bar, again, it is similar to a time-based bar where we have an open, we have the range of that particular price move, and then you have a close. Now, the range bar uses a standard bar with high-low OHLC, basically open, high, low, close, and each bar represents a particular price range rather than a time period. Okay, what do we mean by a price range? Okay, now this movement might be a 5 rupee movement. Okay, so every time price moves by 5 rupees, one bar will be formed. Okay, what have we done till now? We've done volume, okay, where we said 1 million shares. We've done ticks, where we said 5,000 ticks, which means 5,000 transactions or 5,000 orders. Now what we're doing is a range. Okay, now every time a particular range has been broken, then there'll be one bar that will come up over here. Okay, each bar does not represent an interval, but what it does is that you are basically saying that okay, this bar represents a 5 rupee movement, this bar represents a 5 rupee movement, this bar represents a 5 rupee movement. Okay, every time what you see in this particular bar is that you'll open at a particular price. Okay, this is the price that you opened at, and if the bar is going up, typically you'll close at a higher price, and that will be the close of that bar. The second bar will again open. So suppose this is 100, the next bar will form at 105. The first bar will close, the next bar will open, this will close at 110. So in most cases what you'll see is that the bottom of the bar is the open, the top of the bar is the close. But let's look at what has happened over here on this bar. Anybody who wants to explain that? Do you want to try? Or what has happened over here? Okay, in most cases what you're seeing is that you do not have a wick. Okay, basically it's opened over here, gone up $5, gone up $5, gone up $5, gone up $5. Okay, but in this particular bar it's gone up $3, it's come back and closed over here. Okay, which means it's closed at this level, which is $5 lower. Okay, but over here, because a new bar has not been formed, because not crossed the $5 limit. Okay, it has only gone up $3, and then it has gone down and closed over here, gone down $5, closed here, $5 here, gone down by $3, probably come up $5 over here, gone up $5 for $5, and that's how this particular bar is formed. So if you look at something like this, what has actually happened is that it opened over here, went up, but it did not cross the threshold on which a new bar would be formed. It actually went down, and then it closed over here, which is minus $5, and that is where this particular bar was formed. So the size of each of the bars would nearly be the same, but what will happen is that every time the $5 range has been broken, that is where a new bar would form. Okay, now over here what they've taken is only a range of 50 cents, but whatever range that you take, each bar represents a 50-cent movement in this particular case. Okay, a left hash mark denotes the opening price. Okay, as any uh, as any bar chart. On the right hand side is where it has closed. Okay, in most cases the right bar always occurs at the top or the bottom of the range bar. Why? Because over here, only if the price is moved by 50 cents will this particular bar close. If the price has not moved by 50 cents, then this bar will stay open. It does not matter what is the time that it is taken to make that 50-cent jump in the price. Okay. Again, till now we've seen volume bars and seen tick bars, and both of them really talked about what is the volume. Here, it talks more about the volatility in the prices. So if there are a lot of bars that have come in a particular window, suppose in this window you have a lot of bars, that means the prices are moving up and down very quickly, or just moving up or just moving down very quickly. So a range bar denotes volatility because it shows how quickly prices are moving. Again, at the bottom, the dates are just provided for information. It does not really tell you exact movement. So over here, you can see that there are fewer bars that have been formed from one day to the other. Here, there are more bars that have been formed between these two dates, and which basically tells you that there's more price movement that has happened within 312 and 314 versus the price movement between 318 and 321. Okay, so basically March 18 to 21st. Questions on range bar? Okay, but do remember the different types of charts because again, those things come up in the exam, and a lot of times the way they give you the options, it gets very confusing. So if you're not very clear with any of the chart patterns, you'll find it very difficult to answer those questions in the exam because it's not very apparent from the different choices that you get what is the correct answer. So you need to be very thorough in terms of your understanding before you attempt that question. Okay, the next thing that we are looking at is the y-axis. Till now, we've only focused on the x-axis, which was at the bottom, and most of the time we had time scale at the bottom, but there are times that the time scale is not relevant because what we are measuring is the activity, not the time that uh, the stock has spent at a particular price point. Okay. Now, what we're looking at is the y-axis. Now, on the y-axis, there are two different things that we look at. One is the arithmetic scale, and the arithmetic scale is nothing but a regular chart that we look at, where on the bottom you have the time, okay, but on the y-axis you actually have the price intervals. Okay, so it can be 100 rupees over here, 120, 130, sorry, 120, 140, 160, and that's how it will go. And each movement up or down basically represents one unit of price. Okay, so most of the times the vertical axis is the one that we look at, and in most cases that suffices our needs. It shows us how the prices are moving upwards or downwards. But there are also times where we need to look at something called a log scale. Now, log scale, what it does is that it actually adjusts the prices in a manner that you see the same amount of movement for each percentage move on the prices. So on a log scale, if the prices move from 10 to 11, okay, which is a 10% move, the way you'll see that particular bar, the size of that bar will be the same as once the price moves from 100 to 110. In the arithmetic scale, this would be a 1 unit movement. Okay, this would be a 10 unit movement. But in a log scale, this will also be a 10% movement because the prices have moved from 100 to 110. Now, typically, when do we use an arithmetic scale versus a log scale? You'd use that when you're looking at longer term charts and there's been a huge price movement. Typically, if if the price movement has been more than 5 to 6 times, you're better off using a log scale versus an arithmetic scale, because that kind of tells you in percentage terms whether the movement is higher or not. Let's complete this section and then we'll go back to trading view to see how you can depict log scale on trading view. So not only does the arithmetic chart make it difficult to perceive the significance of price movement at lower price levels, because what will happen is that you'll see a lot of companies where the prices are like this for the longest time and suddenly the prices have started moving this ways. But what you don't see is that over here, if you caught the price at this level, this would probably be a 50% move from here to here. And if you got the price over here, this is a 50% move on that particular price. And that is something that you'd not be able to see if you only use uh, an arithmetic scale chart. So we'll go to trading view and see that. So the vertical distance between $1 and 2 is 50%. Okay, on an arithmetic chart, it would be the same between 11 and 22. Sorry, it would be the same on a log chart when you're looking at 11 and 22, because both of them are 100% movements. Okay, so typically when there is a very large gain or a long time has passed, okay, you're better off using a log scale versus a arithmetic scale. Okay, longer term charts that exceed a few years should be plotted on a log scale, and whenever there is a price movement of more than 20%, typically a log scale is better than an arithmetic scale. And just remember these numbers, because in the exam they can ask you when is it that you would switch from an arithmetic scale to a log scale.